Welcome to The Explainer. I am so glad you're joining us today. Because, look, if you've ever stared down a dense 50-page corporate earnings report and thought, do I need a PhD just to find the real story buried in all these numbers? Well, you are absolutely in the right place. Today, we are taking the Citizens Financial Group Q2 2026 earnings report and translating it into a dynamic, compelling business case study. We aren't just going to look at the math. We're going to really understand the mechanics of how a major regional bank operates, adapts, and grows in a pretty complex economic landscape. Here is our game plan for today. 1. The big headlines. 2. The twin engines of interest and fees. 3. The massive private bank boom. 4. A credit quality health check. And finally, number 5, the future outlook and risks. Okay, jumping right into section 1, the big headlines. Let's talk about Q2 2026 net income.
$587 million. That's the net income Citizens Financial Group pulled in for the second quarter of 2026. But honestly, the absolute number isn't even the most powerful part here. It's the velocity behind it. We are talking about a staggering 35% year-over-year surge. In the banking sector, moving the needle that much on your bottom line in just 12 months, that is a massive indicator that underlying strategies are just firing on all cylinders.
And believe me, management knows it. Chairman and CEO Bruce Van Saun put it bluntly in the report, stating, "We delivered an outstanding second quarter, led by strong revenue growth, significant positive operating leverage, and favorable credit performance." Now, that's not just your standard corporate cheerleading. For leadership, this kind of earnings beat serves as hard validation of the strategic initiatives they've been putting into place, especially their big investments in wealth management and the private banking sector. Now, if you were to look at the official key financial data table straight from the Q2 release, it is incredibly dense. It's exactly what Wall Street analysts stare at all day long to build their models. It's packed with acronyms, and frankly, it looks like something you'd need a magnifying glass and about a gallon of coffee just to get through. But don't worry, you don't need to memorize any of this. We're going to take all that raw data and immediately break it down into something way more digestible. When we map out that net income growth visually, the leap is crystal clear. Going from $436 million back in Q2 2025 straight up to that $587 million mark we just talked about. And right alongside this, they managed a 41% jump in diluted earnings per share, landing at a very robust $1.30. That right there, that's the kind of clean upward trajectory that investors absolutely love to see. Moving on to section 2, let's pop the hood and look at the twin engines driving this growth: interest and fees. Just so we're all on exactly the same page before we dive into the results, let's talk about a bank's primary engine, net interest income, or NII. Simply put, this is just the difference between the revenue a bank earns on its interest-bearing assets, so things like commercial and retail loans, and the cost of its liabilities, which is the interest they pay out to you and me for our deposits. It is the absolute core spread of the banking business. So, for Q2 2026, Citizens' net interest income hit a very healthy $1.63 billion. That's up 14% year over year. What's actually driving that? Well, the report outlines that this growth was largely fueled by fixed-rate asset repricing, meaning they were able to adjust the rates on their assets to better reflect the current market, along with improved funding costs. Essentially, they widened their profit margin on the good old-fashioned business of lending money. But here's the thing. A modern bank literally cannot survive on interest alone. While loans drive that NII we just talked about, non-interest income, which includes stuff like capital markets and wealth management fees, acts as a really vital secondary engine. It shows off a highly diversified business model. Because if interest rates decide to swing the wrong way, these fee-based services step in and provide a much-needed buffer. And looking at the specific breakdown of that fee-based growth, things get really interesting. Non-interest income grew 8% sequentially from the first quarter. But check out the heavy hitters here. Capital markets brought in $153 million, and wealth fees hit $102 million. Both of those aren't just good numbers. They actually set brand new all-time records for the bank. It is absolute proof that their strategic expansion into wealth management is paying off handsomely.
All right, section 3, we're going to isolate what might be the most fascinating operational win of the quarter: the private bank boom.
$17.8 billion. That is the period-end spot deposits for Citizens Private Bank. What makes this number so spectacular is that it represents a 7% surge in just one single quarter. Capturing that much high net worth capital in a 3-month window is an incredibly aggressive, highly successful market expansion. People aren't just hiding their cash under mattresses, they are actively trusting this bank with it. Now, you might be wondering, so what? Why do these deposit numbers actually matter to the bottom line? Well, this massive influx of high-quality deposits translated directly into profitability. The private bank alone contributed 15 cents to the overall earnings per share in Q2. That is a huge jump from the 11 cents it contributed just a quarter prior. It proves this division isn't just a side project, it's a high-yield growth engine. Let's look at how this builds into the broader health of the balance sheet. Total period-end deposits grew by over $1.5 billion from Q1 to Q2. The report clearly lays out that this was almost entirely fueled by that private bank boom we just discussed, right alongside some commercial segment growth. And because they've secured so many deposits, the bank is sitting on a very healthy spot loan-to-deposit ratio of 79.5%. Basically, this means they have a fantastic liquidity profile. They aren't over-leveraged, and they've got plenty of deposits to comfortably fund their lending. Which brings us perfectly to Section 4, time for a credit quality health check. Because remember, revenue is vanity, but the balance sheet is sanity. To really understand this, we need to look at a metric called net charge-offs, or NCOs. Simply put, this is the percentage of loans that a bank believes it's literally never going to collect, so they have to write them off as a total loss. In banking, you obviously want this number to be as small as possible. It is the ultimate truth teller when it comes to the underlying health and risk of a bank's loan portfolio. So the crucial point here is that Citizens' net charge-off ratio actually dropped to just 0.37% of average loans and leases. That is down 2 basis points from the prior quarter and down a really significant 11 basis points from a year ago. Think about that for a second. At a time when some banks out there are struggling with defaults, Citizens is actually seeing their loan portfolio get healthier and more reliable. It proves that this massive revenue growth is built on a solid foundation, not reckless lending. Non-accrual loans, meaning loans that are at a high risk of default, actually decreased by 4%. The report attributes this to the bank successfully working out their general office commercial real estate portfolio. On top of that, they maintain a very strong allowance for credit losses, basically their rainy day fund for bad loans, holding incredibly steady at 1.48%. They are growing fast for sure, but they are playing it very safe. Finally, Section 5, Future Outlook and Risks, and how they're navigating global headwinds. Now, in the forward-looking statements of the report, management impartially outlines a very dense, volatile global environment. They're watching ongoing geopolitical instability, specifically mentioning the war in Ukraine and the conflict in the Middle East. They are actively navigating inflationary pressures, a complex interest rate environment, commodity and foreign exchange volatility, and, of course, heightened cybersecurity risks. It's a stark reminder that even after a stellar quarter, banking is an industry that demands constant, vigilant navigation through some pretty intense global storms. Yet, despite all those explicitly stated macroeconomic risks, leadership's tone remains incredibly resolute. CEO Bruce Van Saun closed his commentary by saying, "We remain confident in our momentum and outlook through the remainder of 2026 and for 2027. And this confidence, it's backed up by hard data. They have a strong capital buffer, indicated by a solid 10.4% Common Equity Tier 1 or CET1 ratio. They clearly believe they've built the fortress balance sheet required to weather these external storms while continuing to execute their internal strategies." And that leaves us with a really fascinating question as we look ahead. How will regional banks, just like Citizens, navigate the incredibly strong internal tailwinds, like this massive private bank boom and record-setting fee revenues, against the undeniable headwinds of global economic instability through the rest of 2026? The numbers tell us Citizens has built a sturdy ship, but the waters ahead, well, they remain uncharted. Thank you so much for joining me on this explainer today. Keep learning, stay focused, and I will see you next time.